As we said, oil prices spiking on OPEC production cut. So what was the instigator here? It is $100 barrel oil on the horizon. Let's discuss this with Blue Line Futures President Bill Baruch and Neal Dingmann, Truist Managing Director, Energy Research. Good to see you both. Bill, we'll start with you. How much did geopolitics play in here, and how much is strictly the price action we've seen in recent weeks and months?
You know, I think there's quite a bit going on behind the scenes here. White House didn't fill the SPR, but they had a little bit of an opportunity to. At the same time, there's a lot in the news right now with China making deals with Saudi Arabia, making deals with Brazil, trying to go around the dollar potentially. There's definitely some just interesting narratives to keep in mind here. For me, what I'm seeing is we've got a somewhat negative at the end of last year on oil. It's difficulties of trying to get above 82, 83 on a technical basis, losing the speculators in the market. You saw open interest just continued to erode into the end of last year. And we finally got the flush out, really a cleansing in the last week was the bottoming process that really began through into last week. At a 5% move last week on Monday, another more than 5% move today. We haven't had a 5% move in oil going back to November, and then prior to that was May. So these are big moves here, and I think that cleansing allows the speculators to start maybe coming back, a little reaffirmation now with this move. But we got to get above $82 to $83. It's been a really big ceiling there. So until that happens, this is just a nice big little bounce up rebound.
Well, here we are today, just above $80, just below $81 a barrel here. Neal, how has this at all changed your price forecast, either for year end or even out into 2024?
I think it does put a floor on prices, and I come at it a little bit different angle. I think about my producers. I cover almost 40 odd names, and what's interesting, I think at one time the U.S. producers were, I would call them the swing factor when it came to supply out there. And what we've seen is prices were over $90-ish not terribly long ago. Then they recently were down to $60. What I noticed from almost all of my public companies, they're not changing their plans. So I think what the U.S. administration realizes now, as much as they might want it, the U.S. is not going to be that swing supplier. Unfortunately, now looks like it is in the hands of OPEC Plus, most likely, specifically Russia and Saudi, and they stepped in and made a big call where 5 years ago plus the U.S. companies probably would have stepped in and made the call themselves, and that to me is just no longer going to happen.
Bill, you referenced the Strategic Petroleum Reserve. What position does this put the White House in terms of it filling that at some point in the near future?
I think they're going to be stick to the narrative they said about a month ago, that they're going to look to, in the future. I think they're probably looking out to later this year, potentially, if they get another opportunity. But I do agree, with the gentleman here that he's saying that there's a floor in the market now. And I think looking at it from a technical basis, 75 area was the close on Friday. That's going to be basically that gap. If it does start selling off, there's an air pocket there. I also agree that you're not seeing production, coming back online from the U.S. They're going to struggle to get above 13 million barrels here in the U.S. And then on top of that, it's expensive these oil services companies have raised the cost. Just logistically, it's hard to justify bringing it online. And then these energy companies have become lauded by investors here with the dividends. So sort of affirming the dividends. And I think that they're looking at it from a different game here now. And these companies, we're very overweight energy. We added Pioneer early last week and bring us up to about 15% weighting in energy right now. And my fear really was some of these E&P companies tethered to that price of oil. If oil wasn't going to rebound, they could sort of languish a little bit lower. But it does get me excited. I still want to see more from the market in the underlying crude oil. But I am excited for this to be reinvigoration of a bull move.
Neal, you mentioned the several producer companies that you do cover. Of those, who's best positioned here to benefit from today's news?
I think you have a name that comes to mind right away is Occidental Petroleum. You look at Oxy, and the knock was they still had a bit too much leverage. But again, in a market like this, where as Bill said, you probably have a new floor. People don't worry about that. You have Buffett coming in and Berkshire buying a lot of that stock. So Oxy seems to be sitting very, very nice. Another one you look today is doing very well is Marathon MRO. Again, Bill was talking about, you talked about shareholder return. Marathon bought back almost over 15% of their stock last year, and we think they'll buy back almost the same. So you look at it in a 2-year period, buying back almost a third of your shares. That's hard to beat. And then maybe the last one that we would say is Diamondback Energy. We think they are, Bill hit a key point, and that was service costs are going down. But if you look at FANG, they are by far the lowest operator. We have them at a break even of less than right around $30, which is much less than anybody else. So, a time of higher prices, you don't worry as much about cost, but their margins just hit right to the bottom line, and they're just a fantastic producer.
Bill, do you have any names? And we talked about a floor there. What about the ceiling by the end of summer? Is $100, is $95 as Goldman Sachs suggested possible?
Yeah, I think 100 could be a little bit of a magnet, but I'm not going out on a limb just yet. I got to see a weekly close above 82, 83 bucks. Like I said, we are, you mentioned names. We're 15% weighted in energy right now with Chevron, Marathon Petroleum. I mean, we really do like the refiners. You're not seeing Marathon Petroleum benefit so much here today, but seasonally gasoline hits a very bullish time at the end of March, really into Memorial Weekend, and some of these refining margins can be a tailwind to some of those. So we like Marathon Petroleum, Schlumberger we own as well. We've had Pioneer for a while. We cut at the end of last year, just kind of worried about a washout in the market. We finally got that washout, and that's why we added Pioneer back. But from another standpoint, we saw in the futures contract there was a massive short position that was actually that last week's move was really a lot of short covering early on, confirmed through the commitment of traders. So I think this move here is welcoming fresh buying, because the move up from the below 70 to about 75 was majority of short covering. So I think this is inviting the speculation back, and the open interest, as I mentioned early on, was very low. So I think we can get above 82, 83. It's not going to happen overnight, but if we get above there, I think this could really start invite some fresh buying into the market.
Bill, what do you think it means for gas prices? Because we're getting into pretty soon, sooner than we know it, getting into the heavy summer driving season. Are we going to see gas prices back above $4 a gallon?
I'm not jumping on that limb quite yet, but I think I would imagine so. I mean, usually these things run up into June, and they stay sticky through the summer. So, from the makings of what we're looking at right now, I imagine we're going to see these bump up here for the next couple of months.
All right, Bill Baruch, Neal Dingmann, always great to have you. Thanks so much.